All right, so a pleasant good morning once again. So those of you who came on the call after my first greeting, let me say again, Happy New Year. And thank you so much for joining us today for the Small Business Association's members information session. It's by way of background for those who may not know, we organize a webinar every month, the part of our educational series. In these webinars, we address topical issues, we provide experts across a myriad of fields to help our members and by extension our partners do better business, grow in the various professions, be educated about what's happening within the economy, issues of regulation and legislation, as well as overall business development. And so we are very pleased this morning for this first webinar in 2024 to have Jeremy Stephen with us, noted economist, to share on this very critical topic at this time, the business of banking, navigating the recent developments in the banking sector. I want to welcome you, as I said, on the call, and just by way of one or two housekeeping matters to let you know that our sessions are recorded. So in the event that you missed any aspect of it, you can visit our YouTube channel. Actually, I'm going to invite you to subscribe to our YouTube channel. You can watch via our website in the SBA TV segment, and you can also view this again on our Facebook page. So need not worry, the sessions are recorded. At the end of our presentation today, we're going to have a very short survey, feedback questionnaire that we're asking you to complete. This is going to give us some critical information on our session today and help us as we plan for the months to come. So please don't run off at the end of the session. Stay with us for an extra 5 minutes and complete a very short evaluation too. Now, as I said, this is a part of our educational series, and we hope that our members and partners will really benefit from the discourse today. At the end of the presentation by our keynote speaker, we will have a session for questions and comments. So we're going to use our chat feature on this Zoom platform for that component. So get your thoughts, get your questions ready, and immediately after the presentation, we would have that question and answer segment. So again, we look forward to your active participation. Now, our speaker today is no stranger to us all. I'm sure you will agree with me. He has been on many of our platforms in the past, sharing with our members, with our partners on very critical areas of business development and national development by extension. But just in the event that one or two of us may not know, Mr. Jeremy Stephen is a well-known economist with extensive experience in financial and technology academia, venture capital, private equity, and pipe financing, pipe financing in Barbados, the Eastern Caribbean, and internationally. His core specializations are in financial and economic analysis, as well as modeling and web development, financial training, along with internal corporate advisory services and management of both internal and external financial monitoring systems. He's currently an economic consultant at the Food and Agricultural Organization of the United Nations, chief examiner for financial services studies at the Caribbean Examinations Council, and has been a member of the UNDP Small Grants Program Steering Committee for the past 10 years. Now, his other interests obviously include software programming, technology, and engineering, as well as aviation entrepreneurship. So he has some interests that I believe, will help us to appreciate his current pursuit. So without any further ado, colleagues, let me welcome at this time Mr. Jeremy Stephen to share with us today as we look at the business of banking and navigating the developments in the banking sector here in Barbados and by extension, the region. Good morning to you, Jeremy, and welcome. How are you doing?
I'm well. Good morning, all. Can everybody hear me well?
Yes, we can hear you.
All right, perfect. Thanks for having me again, Dr. Walter. And my apologies again for being late. The irony is that it wasn't technology's fault. It was actually I was doing survival training. I'm in the middle of doing survival training right now, in line with my aviation entrepreneurship venture. So took a little while to get out of the water. Let me put it that way. I was out on the water. Nonetheless, if you guys can hear me, thank you again. The signal may be a little bit challenging where I am right now, so I do apologize for that. But however, my hope is to bring over a presentation that makes sense to everybody. And without much further ado, let's get on with it. Stand by, there we go. All righty, everybody can see the presentation right now? Just give me
Yes, we
some
can see
feedback.
the PowerPoint.
Perfect,
Yes.
perfect. So I wanted to take a different spin from what others might be expecting today. We wanted to explore the business of banking, navigating developments in the banking sector. Yes. Now, all of you, or at least the majority of you, I would take it that you're entrepreneurs, business persons, and a few of you are just here for knowledge. And of course, we all were shocked, not so much so me, right? But we all were shocked by the move by one of our banks. I'm not sure if I'm allowed to call names in particular in a critical manner in this forum, but it is a fact. So when one of our local banks would have installed fees for ACH transfers, that would be automated clearinghouse transfers, and using the real-time gross settlement system. Basically, if you wanted to send money from one account to another, it's not necessarily a very common term, but the ACH is a very interesting mechanism. And as we go on, I would try to explain why they might have been thinking of doing that. Actually, there is a core part of this presentation that explains as opposed to expose. I'm not in the business of exposition or exposure, as some may believe. Also, with this presentation, I wanted to ensure we had a forum for discussion. And again, I'm thankful that that has been provided. So as far as we are concerned today, I wanted to start with a definition of what a commercial bank is. I think to really understand going forward why the banks are going in a direction that they've seen to go on in, you have to really boil right down to what a commercial bank is. You have to also appreciate the landscape in which a bank operates. A lot of us here have credit union accounts, or sorry, are shareholders within the credit union movement and are thinking, okay, well, if I take money out the bank because I'm not satisfied, then the credit union should be an ample, let's say, substitute. I'm here to tell you that is not necessarily the case, and a lot of that is because of legislation. But it's still a good alternative once, especially that legislation comes to be. I think a lot of people do not appreciate how banks make money. And by understanding how banks make money, then we could fully appreciate a discussion of the fees and the types of accounts that banks have. All right. And those developments within that fifth section I would try to break down how it can impact small businesses going forward, especially since many of you as proprietorships as opposed to corporations, right? So many of you would be affected by some very simple, let's say, strategies that banks may have available to them, and also by extension credit unions as they would be affected. So essentially, I think people need to understand that banks are stores of value. Sorry. Banks are essentially stores of value, nothing more than that. They also provide other forms of services that all of us have been exposed to. We know about the fact that they will lend money, but principally they were created to store value. So a long time ago, some guys in Italy decided, let's give some blacksmiths some money and they would give us some coins. And those were the first banks, believe it or not. So what I would want people to be very cognizant about is the fact that there are separate types of banks as well. So when you are thinking of Bank One or Bank Two, in other words, RBC, Scotia, any of them, First Caribbean, CIBC, Republic, First Citizens, and now Sagicor Bank, they would have several functions. My computer's going off right now. Thank you. They would have several functions that lie outside of commercial banking. Again, as residents, as people, as the small man, as people like to proverbially say in Barbados, very few of those services would be given to us. But you've got merchant banking services if you have a corporation, if you have a need for factoring, which in Barbados used to be a thing. That's essentially where you submit invoices that are to be paid to the bank because you figure you need the cash now, and say these invoices were to be paid in 30 to 60 days, depending. The bank will give you not the full amount, but a fraction of the amount, sometimes 60 to 75% of what was the invoiced amount. And when the money comes in 30 to 60 days, then you pay the bank the full amount. The difference that the bank charges is the remaining amount, and you view that as a form of interest. So banks predominantly either make money off of interest or some kind of transactional fee. So you can view it as a transactional fee or interest. I used to tell my students, think of it as interest, because you're borrowing a fraction of the invoice value from the bank, and you're giving back the bank the full amount of the invoice that you were supposed to be paid. So you're taking a fraction of the invoice, the remainder you could view as interest because you are borrowing money, all right? Commercial banks, and through their merchant banking arms, also engage in foreign exchange. They engage in procurement services. That's when merchant banks go and help you purchase items for import purposes. Now, that isn't typically available if you are a proprietorship, because as far as you're concerned, you're just taking savings accounts or checking accounts. And you may or may not, depending on if you have a salary, because most of our banks aren't modernized per se, or you have a very strong track record and you keep accounts to present your accounts to the bank regularly, and they realize that you're not that much of a business risk to them as a proprietor, and therefore having an individualized account, not a business account per se, or a trading as account that is personal, then you can actually access loans, which is a common function of commercial banks, but merchant banks would deal more so with the corporate side. Then there's the investment banking side under number two, where you have large scale projects, say the likes of a CO Williams or the likes of a Williams Industries, when they go to the bank, or what used to be Simpsons and ITC in Barbados for a while, just to call some big local companies. When they wanted to finance a project, build a new building, invest in some type of infrastructure, even to bring in equipment, they would principally go to the banks, and the investment banking function would probably take hold there. So we don't have investment banks alone as standalone industries in Barbados, with the exception of one that comes to mind. I think Citibank has an investment banking arm that is over there, Wildy. I'm not even sure who they deal with right now as a company. I used to know this. I think Simpson was a client. But again, if they wanted to engage in large scale projects, many of us here don't have that opportunity. You would go to these guys and they would underwrite the deal. They would find other investors. You call it loan synchronization. So they would talk to other banks if they did not want to take on the risk themselves, and they will lend to you. All of this happens in Barbados, right? And so it's not just savings, and it's not just taking deposits from people and lending it out that a bank makes money. But a large proportion of the money that is made, or rather a consistent, this is a key word here, a consistent proportion, a regular cash flow that comes into the bank is done through loans. And the bank basically takes your deposits and finances those loans. However, this is something a lot of people, and I should have added this in this presentation, tend to forget. A bank is the only institution, believe it or not, outside of the central bank through a different mechanism that can create money. I don't think many Bajans understand this at all. And every time I explain this when in my old life as a lecturer at UE, you know, I would expect younger students to not get it, but it was always the mature students that would find this very strange. But I mean, if you have the time or inclination, if you're comfortable, if you're financially literate, as I would love everybody to be, and you read any bank's financial statements, particularly those in Barbados, you would realize on the liability side, the debt, you see deposits. The deposits are always a fraction of the assets. But also, here's the catch. If you look on the asset side, the cash that you think that is in the bank is always a small proportion compared to the deposits. In other words, I mean, this is a rough way to say it, but just to get the point across. If you deposit, given what I know, if you deposit $100 in the bank in Barbados, which in cash, truthfully, only $10 of that, $10 to $20 of that is kept in cash. In other words, and I'm not trying to promote anything called a bank run. A bank run is when everybody runs and tries to withdraw their money, but this is education. Truthfully, in the event that everybody wanted to withdraw their money out of the bank in Barbados on any particular day, and they all go to the bank cannot give you everything in cash. They can't. They would have invested it in assets. They would have invested it in assets, some type of loan. And then the joke is the majority of us aren't even paid in cash. No, you know, our money is wired to our accounts or you receive a check. And those are forms, those are monetary instruments, but there's not cash. Checks make no sense in an economy that the banks aren't lending, but that's a complicated relationship I don't want to explore. But the point is that there comes a point when economic performance is so bad that cash is what is desirable. And even past that, there comes a point that cash has no value. But the point being is that, you know, if everybody in Barbados today decided that they were going to withdraw money from the bank, there's no way these banks, no matter how much money you thought you put in, could ever give you back all that you think you had in there. So this is why when one social media commentator, hear me calling somebody a social media commentator, last year stoked up fear in the credit union, in a certain credit union, and everybody ran down there. It was like, what the hell is he doing? That's crazy. That is crazy. Even if they're practicing, yeah, I see what you're saying in terms of any bank in the world, but I'm speaking about Barbados. Again, this isn't what I'm saying here. I'm specifically speaking to in terms of Barbados. If I wanted to make a distinction or let's say connect with anything happening elsewhere, then I would make that distinction. But take it as I'm speaking about Barbados, but what I'm saying isn't terribly unique unless I specifically say so. Okay? Let's make that a very upfront thing. But with the effect of deposit insurance, again, I wanted to speak about the differences with credit unions later on. There's an aspect of insurance within accounts in Barbados called deposit insurance. That is where up to $25,000 per bank it never was per account. A lot of people think so, but per bank is insured. In other words, if you have two bank accounts in the same bank totaling $50,000, so it's $25 an account, you're only insured for half of that, all right? So everybody's still at risk to a point, and then deposit insurance is not, you don't get all the money one time. And Barbados is a relatively illiquid place. So that's why it's important to have confidence in the banking system. This is why it's important, given that we've invested so heavily in it for the last 50 years as people, and we believe in it to a point, even through the credit union movement, which is part of the banking system. It is not a part of it. And I'll explain that in a little bit. Pretty much everybody's exposed, so everybody needs to act in good faith. All right, so it's a bit difficult to really appreciate how important the banking system is in general, regardless of where it has gone. Now, I wanted to explain the concept before I move on, explaining other functions that commercial banks serve. This whole idea of something called fractional reserve lending. I had to open up before I strayed off a bit about the fact that commercial banks are the only entities outside of the central bank which does it through a separate mechanism that can create loans out of thin air. So for every dollar it takes in either cash deposits or let's say other monetary instruments like checks and wires, because wires are not cash, believe it or not. It's just money. It's not cash. Cash is a form of money, one of many forms of money. There's 3 broad types of money, well, really 4 broad types of money. But the point being is, for all that they take in, they can generate a multiple of that. And typically in Barbados, I think it wavers. I've heard sometimes for every dollar that's taken in deposits, the bank may choose to lend up to about what? 1.8 times. So $1.80 for every dollar that's taken in, $1.80. I've heard for some, and I've heard more for others in loans are generated. And the legal infrastructure, the legal charters, the law that drives banks into creation, the law that, well, the National Payments Act is one aspect of it, but the laws that allow banks to be chartered in any place in the world, it's not unique to Barbados, allow banks to do that. Credit unions cannot. And that's one of the major strikes against the movement in terms of facilitating shareholder loans. They can only lend what is taken in. And it's not necessarily a bad thing. It just means you have to have more fiscal discipline, because it is that facet of fractional reserve lending that has led to booms and busts of the banking system worldwide. And because it is relatively untethered at points in the United States of America where you have huge lending sprees, everybody's taking a mortgage, it's easy to get a home in the US, easy to get cars, easy to take that money, borrow it if you have a relatively good credit rating, and invest it in stock exchanges and in stocks and all types of assets, all forms of assets at one point, even Bitcoin, even cryptocurrency. You can see then that, this money has to be paid back. And if you're not receiving income from these activities that is sustainable, then of course the banks don't make any money. You have financial collapse that then spreads through the system. So that happens almost every 10 years to a T in the United States of America. And in fact, the system needs to operate that way because it's a credit-driven system. You need to create loans in order for the United States of America to work. It's a consumer-driven system. Over 90% of their economic activity is driven by consumerism. Barbados is 80%. So when you see that happening, you need loans to be generated in order for companies to borrow, yourselves to borrow, to produce inventory. If you're service-driven, to get the tools that help you to be service-driven, the resources and whatnot, the materials for those that are product-driven, and then to serve the wider public. You need that. And you need, that also drives your prices higher over time. In fact, it is the act of lending that is one of the major incentives behind inflation globally. In Barbados, we import our inflation, but in the US, inflation, according to the Federal Reserve, is driven by lending activity. Hence why the Federal Reserve over here raised interest rates, forcing all banks to raise their interest rates. That was the thinking. Mind you, it did not work for another reason. So I gave that long spiel just to tell you that banks inevitably are hard woven into the social fabric. This is why when I'll call his name, because it is a fact, Mark Adamson, when he was campaigning, I don't remember if it was the 2018 election or the 2015 election, 2014 thereabouts election. I don't remember when the election was before that, but one of those 2 elections, Mark Addison was campaigning and was saying that he wanted to get rid of interest rates. And I said to myself, my God, he does not know what he's talking about. And it's not to say that Mark is very smart. I actually have time for Mark, even if we don't agree, right? But the whole idea of telling banks, don't charge interest rates. You either need to have them charge some kind of other fee. If it is fee-based income on transactions, which is one of their ways of making money, as acting as an agent, that's point number one here. Or if, as they do with Islamic banking, which is principally that the banks invest with you, so they share that risk. Remember, loans act as a form of guarantee of income for a bank. All right. Always remember that you're going to borrow. It means you are guaranteeing these people that you will pay what you promise. Versus if you're an equity partner, equity partners take on the likelihood that you might not be able to pay them. And then there's mixtures of equity partners and loan instruments and equity instruments, these hybrids that allow you to risk some of the capital with the likelihood of loss. And then the other part is protected. It gets all fancy from there. But pretty much when you're dealing with banks, you're pretty much guaranteeing their income. All right. So with Islamic banking, they act more on the equity side, but there's certain tenants involved in there that allow them to say, well, you're guaranteeing us some form of return. So I always advise people, if you're really smart, just don't buy stuff from the persons in the Muslim community. Talk to them about how they raise money. And to me, I say all the time, if more businesses operated on the grounds of Islamic banking, there's no Islamic banking in Barbados, but the concept is very real. We invest together, we would be a stronger society to this day. There's a reason why the Muslim community, outside of not wanting to engage in interest as part of the Quran, is very much a bad thing, a sin to charge interest and whatnot, and to pay it. So, they long time ago, they decided, well, if we put money in the bank, we don't want any interest. But the funny thing about it is that they finance their own projects using the principles of Islamic banking. So a huge group of them get together and they invest in projects. That's the Islamic bank. You have people in there that specialize within the banking structure in managing those investments, overseeing them, making sure payments are made, keep in touch with persons who took funds. I don't want to say borrowed funds. All right. So long story being short, when Mark said that, I realized he didn't really understand that a bank has to make money, or if he did, he didn't recognize that from the day that banks don't charge interest, it actually means that unless you have a strong governance system within the banks, that these banks actively are out there helping managing investments, and the persons are not sitting down in an office and just taking phone calls, being casual based on the fact that they have a loan and that you would honor that agreement because the loan is protected by law. If the legal structure doesn't allow certain protections, then if you don't charge interest, you're creating an environment where a lot of people would lose money because the banks wouldn't be making, or these investment pools wouldn't be making a lot of money. Almost like a blessing circle. I don't know. I assume that some of you probably are part of them. You get what I mean. I have a huge, and always had a huge bias against them. So pretty much you'll be creating blessing circles in the banking system if you don't have Islamic banking structure or interest-bearing structure. What I could agree with is the control of interest rates, which we no longer have in Barbados. But let's go on. So banks also engage in foreign exchange. In Barbados, because of the heavy control of our foreign exchange sector, they don't make a lot of money there. You will realize the fees are fixed, and then a heavy component or a large component of the difference between what you buy a US dollar for example, and sell a US dollar for, buy a pound for, sell a pound for, the difference is spread between that. A great portion of that spread actually is eaten up by the foreign exchange tax. In other words, the government benefits significantly more from those transactions than a commercial bank would. Or let's say they benefit as much, if not as more than the commercial banks do from foreign exchange transactions. So it's a fairly limited business, though it brings in revenue and it's consistent. I mentioned loan syndication before. The banks in Barbados regularly, especially on large real estate projects like hotels, they pool together their own investments, just as some credit unions do as well, pool together the funds so they can lend to support or to finance specifically very large projects. And the reason for doing that is risk management. You don't want to expose a very large part of your depositors' money. Remember, they can create money as well, but the thinking is you don't want to expose a large part of your depositors' money towards projects, any project that has a risk of failure, and all projects have a risk of failure. So for instance, let's argue that a bank has only, let's argue $1 million worth of deposits. So some small bank, right, just popped up. And somebody comes in and says, well, hey, I want to borrow $500,000. That is significant. Half of your portfolio is going into one project. So that bank would say, well, look, let's partner with other banks and reduce our direct exposure to the project. Okay. So loan syndication is also a service, because the bank that does the syndication, the bank that goes out and finds the other banks, will normally charge a little fee on top for the service. So you get a greater administrative fee, even though you're guaranteeing funding the project, but you're spreading your risk. Another major way that banks make money in Barbados, is not the largest, but definitely consistently, based on the data that I have, is through credit cards. Bajans don't really clear our balances. Balances are very consistent. I mean, ideally, you should clear your balances, but that's not the nature of how things go in Barbados. So, in terms of the landscape, I wanted to really show you guys how big the banking movement, if you want to call it that, is compared to the credit union movement. And the best way to do it is not through assets, but through debt. And when I say debt, this is the debt that pays interest. The blue line represents, and this is really in billions of dollars, not 300 billion, but you just add 3 extra zeros to the numbers on the y-axis. That's a labeling mistake on my end. I'm now noticing this. But essentially, the amount of deposits and loans and other loans to the banking sector, short-term and long-term loans to the banking sector, are significantly greater than the loans. If you see my mouse, or maybe I should use, let me see how you do this again. There we go. Where's my pointers? I haven't used one of these in a minute, but if you can see my mouse so I can save time. The orange line will just be the amount of money that members / shareholders in the credit union movement deposit. I don't like to use the word deposit, but for emphasis, deposit within the credit union movement. Now, 2 things I want you guys to notice, yes? Okay, great. Zaria said you can see the most. 2 things I want you to notice. This is 139 months up to 2023. So basically the start of 2012 up to October 2023. These are the number of months. Now you can see that since the beginning of the, just to be political for a moment, the last decade that we had, up to the end, not the end, but let's say up to very recently, deposits in both sectors rose, even though the credit union movement, as a form of deposits and loans to the credit union movement, did not ever overtake the banking movement. But here's the important thing. Maybe you can see this. I want you guys to focus on the width of the lines for each month. Basically, you would find that the blue line near the end started to grow or widen away, and this orange line, which represents credit union deposits, started to flatten out. So basically, you call this the widening of a gap. So that widening of a gap began after the government changed in 2018. Now, I'm not going to make the obvious connection here right now. What I'm going to make is not very obvious. Remember in 2014 thereabouts, the Central Bank of Barbados liberalized interest rates. Like, give me a share, or give me, not a share, thumbs up or ones in the chat, like what Jordan English used to say, if you remember when that happened, if you're old enough to remember or conscious enough to remember when that happened. Right? Because it's a very important thing. So I need to ensure that enough people at least remember this. I have one so far. Anybody else? All right. A few do not remember. Good. So here's the thing. The Central Bank of Barbados used to control interest rates in Barbados for a long time, for a very long time. That was, the governor and the economists and the banking division, they would get together and look at how loans were being generated, where the loans were going, uh, were loans being paid on time. Pretty much the central bank used to go into, through their bank supervision division, go into banks and audit activities within the bank every 2 weeks. I do not know, since I've long been removed from central banking, if that's become more frequent. I would hope so, but every 2 weeks, every fortnight, they were going and do bank inspections, right? So pretty much that would help the central bank to make very informed decisions as to where interest rates would move. So whenever interest rates went up in Barbados, the central bank was set, let's call it for argument's sake right now, a minimum interest rate, and the banks would charge loans or charge interest rates that were either pretty near or slightly above that, right? So setting a premium. And that premium would be based on how risky you were as a borrower to them. The riskier you were, based on your income and based on your propensity to pay, your credit rating, all kind of factors, the relationship that you had with the persons at the bank, the relevant persons at the bank, that premium would be either very high or low. Low if you're really good, higher if it's bad, right? So that's why everybody doesn't pay the same interest rate. It's all based on all those factors to this day. On the savings end, they used to set that so the banks could never go below a particular rate. So this is why up to 2014, Bajans were making something like 3%, even though, as I showed you here, deposits kept on rising. Now, let me teach you something. Interest is considered the price of money. If you want to borrow money from me, here's my price. That's interest. Likewise, when you're depositing at a bank, you are lending to that bank. It's not the bank's money, it's your money. Every Bajan knows this. So the interest that is charged is the price of your money. So the government, through the central bank, used to say, well, hey, that's the price of your money. The banks can't charge any lower than this. So it was a form of price controls. And then the governor at the time, back then, said, well, we relinquish control. You guys set your thing. We can give advice, but you guys set, we won't have a minimum interest rate. We would only have interest based on the money that you lend us. So by law, and this gets confusing for some people, by law, commercial banks are supposed to leave money at the central, deposit money at the central bank, right? Reserves. These reserves, the central bank would pay interest on to them. These reserves are kept there in the event that there is the same bank runs that I spoke about earlier. People rush in to take out money. The bank will have some money left back to, weather that storm. But the funny thing is, the money does not belong to the people who lend it. So it's only in that, there's that distinction. Meaning, whereas it's your money when you lend to the commercial banks, I can almost guarantee that legally, when the commercial banks deposit that money in the reserves at the central bank, it's not theirs, even though they're making interest on it. It's slightly confusing, but there's legal reasons for it, again, so that the commercial banks don't dip unceremoniously into the reserves all the time. So the central bank controls how you dip into it. Good. So that's where the central bank would influence commercial bank activity in terms of setting interest rates. Also, by through the bond market, through a mechanism that I will not take too much time to explain. All right. So here's the thing that is funny. Since the central bank gave up interest control, or in other words, controlling the interest rates that are on savings accounts and also on loans accounts, the commercial banks would take control and set it. And because they're competitors, yet they're not, the rates of control, we all know this by them. They watch each other and they set rates that are fairly close in terms of what they offer to the general public. Hence why Sagicor Bank could come in and disrupt as a smaller bank and set interest rates, introductory rates that were better on savings accounts than the rest of the market. But remember, I told you guys that interest is the price of money. And if you all see that there's too much of something, you guys are business people. If you produce too much of something, you know that customers would always say, or if there's a lot of competition, so there's a lot of money floating around, or there's a lot of product floating around, I should say, that's similar to yours. We all know, without even taking a class in economics, that that means the price of whatever you're selling has to go down. The same applies to debt. The same applies to deposits. If too many people are just banking money and the bank has too much money to deal with, and they know that the climate out there is such that people will continue to put even more money, the credit unions as well, into them, then they don't have to pay you as much as they did before. You know, it's excess. So this is what drove interest rates down theoretically. Some of us here will not buy it and say, oh, the banks always wanted to cut the cost. But, you know, if the opposite occurs, where everybody takes out their money and decides to sit on cash or, I don't know, do something with their money, buy gold, well, that's illegal in Barbados, buy a whole bunch of assets that they figure they can sell off later in the future. So, for instance, jewelry right now is growing in value. Certain types of jewelry, I should say, and not telling you to go and spend all your money on a gold chain or whatever, but there's certain types of jewelry that's growing. So say people decided that they're doing that, just buying a bunch of precious metals legally as for adornment, so jewelry, then the banks will say, hey, you know, we need your money, so let's raise interest rates. This is the reason why Sagicor Bank raised interest rates on their introductory things. They needed to attract deposits. So you can see generally since 2013 on to now in both sectors, these deposits were growing. So you could expect if this continues that interest rates will remain low on your accounts long term because we're banking and banking and banking and banking. On the opposite end, and I saw a question about what where savings rates are near zero there, near zero. Right now, even banking money isn't really a store of value because inflation in Barbados, I mean, I don't go by central bank numbers when it comes to inflation, but it's definitely above 7%. So leaving money in the bank, every year you lose 7% on it. It's probably better to put your money into inventory and let inflation help you make more money on it. But again, you need to have a nest egg. So for me, leaving money in the bank is more for transactional purposes than saving. That's the be honest truth. It's really about transactions, no. And funnily enough, the banks recognize this, hence why they're doing more fee-based income. So not just interest, but the other aspect of income that we're going to get onto. So here's something I wanted you guys to see that was important. Now, what I showed before was the difference in credit union debt and the bank debt, right? This is also monthly. No, this is assets versus liabilities. Sorry, assets versus liabilities. Something I needed to show you guys. That's very important. And you're getting a complex thing broken down right now. Essentially, you can see in terms of interest-bearing assets versus interest-bearing liabilities. These are basically the assets that the bank, well, let's start with the liabilities end. Simply just deposits. And on the assets end, which is the one in red, you're thinking of short-term loans and loans alone. And you can see that perennially since 2013 until again, down here would be October 2023, that the banks have way more interest-bearing liabilities than they do interest-bearing assets. In other words, traditionally in Barbados, because of the rapid amount of deposits that go into the system, there's so many deposits coming in that there's not enough loans being generated to outpace or to create enough assets that would outpace or be greater than the deposits that have come in. This presents a problem given certain conditions. All right. It is actually not a problem if interest rates are rising, right? When interest rates are rising, and again, if the central bank was in control and pushing up interest rates, it presents an opportunity, believe it or not. I don't really want to make the distinction, so take this as a known. All right, this is from risk management, that in the event that when interest rates are rising in these conditions, then the bank tends to make money. And when interest rates are falling in these conditions, the bank tends to lose money, right? Sometimes they cross it up, but the point being is that this is something called let's call it a maturity gap, where, not a maturity gap, sorry, an asset gap, where if you're presenting more liabilities, in other words, you have too many deposits and interest rates are rising on them. Actually, it's the other way around, right? Sorry. If interest rates are greater, correction, if deposits are greater in value than the interest-bearing assets and interest rates are rising, you pay out so much more money in the short term to deposits, because deposits are short term in nature. And you wait a longer time to take back most of your interest in the loans that you lend out. It presents a situation where the bank has to spend a lot of money in the short term and wait to receive money in the long term. Some of your businesses are like that, where you pay out a lot of money today, but you got these 30-day and 60-day invoices that need to be claimed, and it becomes very expensive. You get cash problems, cash management problems, and it becomes expensive. Versus if it were that you were receiving money like a supermarket on a daily basis, but buying product monthly, you would have a situation where if prices go up on the inventory that comes into the supermarket, it doesn't affect you because you would have had cash up front anyhow to service that. So banks are like supermarkets in that respect. Remember what I said earlier about interest rates? They started falling. Now, falling interest rates are supposed to be an incentive for you to stop depositing as much money. All right. And if people continue to deposit more and more money into the system and there are not as many loans being generated for whatever reason, it could be that the economy is soft, it could be, as is the case, there's a lot of debt consolidation going on consistently in Barbados. And I'll show you that figure. Well, no, I didn't put it in here, but that figure is available through the central bank. And all of these charts are central bank charts. Right, so you have a lot of debt consolidation going on right now. So as a result, it's a riskier environment, and the banks aren't going to charge very high interest rates on the loans, right? And a lot of loan activity isn't being generated for all types of reasons. In the chat, there's good reasons why. And interest rates are falling. That presents a situation, as I told you earlier, because of this gap, the fact that there are more interest-bearing liabilities than assets, that the banks will continue to make less and less money, net income, it'll be less and less profitable through loan generation. Loan generation becomes less and less attractive, especially when your interest-bearing liabilities the gap is widening. And it has widened since, I think this here was when the government changed. No, this was 2017, where you saw this fall here in both interest-bearing assets and liabilities. It might have been that some of the wealthier people decided to withdraw their money, and then it slowly built back up. But look at the gap, distance between these is becoming wider as time moves on into 2023. So as that gap widens, that becomes so difficult for the banks to actually make money. And the forces are that we are forcing interest rates down by putting too much deposits in. So this is, as Kevin said in the chat, the reason why they decided to start using fee income. It is only normal for them to think this way. Now, of course, the banks would have said, hey, we made a lot of profitability. Yes, that's fine. But what this says, this doesn't present a situation where you lose money. You just don't make as much money as you can. Your net income falls year by year. It doesn't mean that you're not profitable. It just means if you made $1 million in profits last year, there's pressure to replicate that million, especially the longer this gap stays and the wider it gets. So like right here, where the gap was at its widest in the earlier parts of the period. This was just after the Credit Suisse loan and whatnot. The commercial banks were not thriving well here from loan generation at all. Right. So as that gap widens, it becomes a problem. And I'm suspecting this gap will widen, and they're suspecting it. And hence why they're focusing a lot more on fee generation to make up that shortfall. Remember, I said they would make the money on the loans, but that amount of money year on year that they're making may fall. So they may want to make up the shortfall because of this gap in particular. Now, I just literally explained UE level risk management to you without showing you the math or the derivatives and all of that proves this. So let's keep on looking into certain factors. This data may be old, but it's pertinent. All right. Let me address some questions that just came through. Why not offer new and better loans? What is meant by new and better loans? Remember, better presents you. All right, think of it this way. You are in an environment as a bank where it is tough for you to make money regardless, right? Based on the fact that too much deposits are coming into the system and the economy is soft. Why would I present a situation where I have too much money and I take on too much more risk with it? Number one, fiduciary responsibility. New and better loans presenting more risk. If I lend to people with bad credit records, what does that say to the depositor in a very small country? That's the first problem. The second issue is normally the banks that would take on very, very riskier behavior, because new and better implies more risk in an environment where this should be taking less risk, right? So if they're doing that, they must have enough capital within. And when I say enough capital, more than what these banks in our country have, right? To actually feel safe taking that behavior. And then there's a legal aspect. Again, fiduciary responsibility. From the time banks start lending and using language that suggests, well, hey, we know we are in an environment where for us, the risk of lending should be lower, but generally the economy is seeing a different situation. This is well known. And we're promoting, all right, we go out and lend. That says to the central bank, well, as their governor, they're taking on riskier behavior that's unfounded. Really and truly, a bank shouldn't be driving economic growth without the support of a central bank. Hence why central banks are important in terms of open market operations, make it easier for banks to get access to their reserves, A, and B, making it easier for the banks to invest in government debt, and then for the government then to start, as it does right now, investing in projects as the case may be. If none of that is happening first, the banks will not lend because the banks are not supposed to be out there driving growth. Banks are there to sustain growth. Driving growth as a bank, no bank would ever tell you, well, we are entering into a new industry first. Again, there's too many risk factors. So when you say new and better, that has a lot of connotations that says to me, well, what is the bank really lending to, right? So a bank would never think in that way. They're not venture capital firms. Those instruments, those types of companies are important, and banks will follow them, right? Those guys at the venture capital funds would have a good rapport. They would know how to manage risk. The banks would feel safe that, yeah, they can manage some of the loans if they're borrowing, and then they go and invest in the riskier ventures, you understand? But the banks themselves would never touch a project that has a shaky foundation. They can't by law, right? But the other thing I wanted to really let you understand is where consumer debt is driven in Barbados. Now, again, why I thought not to show commercial debt is because it's a small business association and I'm treating everybody, or the majority of you, wrongfully possibly, as proprietors as opposed to actual multi-person businesses with tons of employees, and tons in Barbados is more than 25 in my opinion, right? So this affects your ability to borrow to finance your business activity. And funnily enough, these two, being home improvement and real estate and vehicles, are the two things that banks would lend to guarantee. What is important, and again, this is between 1988 to 2010, so this is a bit old, but what I want you guys to take from this is that the banks are not afraid in an environment that promotes it to say, well, hey, I'm not going to lend to small business, but I sure as hell will lend you vehicles before I lend you a mortgage. That actually happened in Barbados. This happened around, I'll tell you exactly when, no. This happened just before World Cup. This boom here, where the banks were more willing to actually lend for vehicles than, and you had a slight uptick in the beginning here for real estate loans. So this was definitely in the build up to World Cup. And this is when the World Cup had crashed out, I think. No, just after the World Cup, and the economy started to go soft post 2008. And at that time, the bank said, hey, let's make some fast money. And decided to really drive up car loans to the point where you had more loans generated in cars than in home. Now, I'm saying some persons can argue that right now, if conditions do permit, that instead of charging a fee-based income, that maybe the banks look at other products, loan products. So not just better loans, but looking into different loan categories, of which there are 5 to focus on. The banks have before driven into homes, not homes, out of homes relative to into vehicles at that time. And it wasn't a case where it was a bunch of trucks and stuff for construction, but just normal little vehicles on the road. All right. So moving on, here's how the loans are broken down. This is why very important to understand. Notice in here, the significant portion here is consolidation debt, in my view. This is a large number. And this is another part of the reason why the loan or lending in Barbados is so soft, because it basically means for every dollar that the banks put out in loans, 16 cents would have to be to consolidate or to basically buy off loans from other banks. It is a useful business, but it also says that there's a 16% chance that that any dollar that I lend to you, there's a 16% chance that I would not receive the full payment at all, or I won't receive tiny payments on it at all. That is a huge number. I mean, suffice to say, debt consolidation in itself is a good exercise to practice, but it normally says that the environment is fairly risky compared. I don't know what the general trend is, except, and this is to answer Ian's question in the chat about the general trend of vehicle loans versus other assets. I can say it's significant. I can't say that at any point in any of the other countries that it literally overtook real estate. But that is an interesting case in Barbados, right? And funnily enough, compared to larger markets, rather unique, that the total amount of loans given out for that time, or not given out, the total value of loans that were out there in the society for cars was greater than the loans that was out there for residential real estate. That was crazy to me to see. That was literally a time, in other words, that Bajans on average were devaluing their wealth, right? Because cars are a depreciating asset, and you had loans on those that were greater, but yet the loans that were on the homes were less. So fewer Bajans probably had invested during that period in real estate, a significant period. That was like over 2 years that we saw, than cars, which is an interesting dynamic. Only other place I think of that would do that is probably Guyana, but it's a cash-based economy. Banks don't really lend on like that. It's changing. But yeah, again, what I wanted to show you, still Bajans significantly like real estate. This is over since 1988 to 2010, on average, prefer real estate, but cars are pretty close in terms of what Bajans would invest in. And you see that there's a section for commercial vehicles. Well, you can really think of these as commercial vehicles. Now, funnily enough, there's no category that the central bank kept. Again, all this is central bank data to show proprietorship. proprietorship could probably be in another section that is somewhat captured in here. And it would just show that banks don't really lend to support even proprietorships, except through private vehicles, right? And yeah, recovery monies tend to be fast on vehicles anyhow. It's lower risk. So we come to the part where I know you guys would want to really discuss the fees and accounts. And I mean, there's a lot of talk about it. We knew that early in the year, Scotiabank surprised everybody with a $1.25 fee for ACH transactions. ACH is automated clearinghouse, and real-time gross settlement, RTG transactions would have attracted a fee. The central bank, through the National Payments Act, said essentially that this was illegal. I'm yet to find the exact section in the National Payments Act that says it is illegal. But again, the banks did the smart thing and didn't fight the regulator on it. But yet, I'm still yet to find the part in there, because I read through the legislation. It seems rather suggestive as opposed to assertive that the action could have been illegal, or at least not something that the central bank would want to promote. So take that as a printable. If somebody from the media is in here, I would need to find that out. All right, Dr. Wold, I'll answer that question later. I'll leave that up. But essentially, the central bank repealed any proposed action to be taken by Scotiabank. So those transactions will remain free for now in terms of ACH transactions and real-time transactions from bank to bank. Essentially, for all of you, automated clearinghouses and the RTG, or however people define it, RTP systems, are systems that are housed at the central bank, but they differ in terms of sophistication. Real-time gross settlement payments are $250,000 or greater that you're moving between accounts. And yeah, I'm going to get to that, Keisha. That would have been Royal Bank that had the $1 ACH fee. Now, ACH is a company that's owned by all the banks, and essentially these banks keep accounts with each other, and basically they use the ACH to basically batch process transactions. In other words, there's probably 100 of you that are sending accounts to 100 other different people at various different banks. The banks will upload these transactions, and then each of them would just correspond with each other to be simple, and they make transactions within their bank account. So each bank keeps a bank account with each other, so they would know, let's for argument's sake, say that Scotiabank knew that they had about 100 orders to move small amounts of money, a little $100, $20, $1,000, between Scotiabank and RBC. Scotiabank would talk to RBC and say, well, hey, I need to get all this over to you. And it's not really over. So what Scotiabank would say is, take from my account at you, my Scotiabank account at RBC, the total amount of these transactions, and put them into these various accounts that are here in this document, this batch processing file. That's simply ACH, right? And real-time gross settlement is a little different. It's housed at the central bank. Each bank holds an account at the central bank, and then the same thing occurs where there's a file that comes through, money needs to be sent, a little $1 million, like Charles from Premium Designs needs to send $1 million over to Dr. Holder. That goes through the real-time gross settlement system. Typically, it happens in real time versus a delay, which happens in the ACH. With the ACH, there needs to be a lot of transactions that need to build up first, and then they're posted, hence why smaller transactions take a while to go through. But then with the RTP, or the real-time gross settlement system, that goes through real time. So that has a sophisticated level of security and technology, and involves even a bigger party, that being the central bank that overlooks the transactions. So it's pretty expensive. Now, these things, in my view, should come at a cost. In Barbados, they don't attract a fee. Everywhere else they do. And in Barbados, for many reasons, it could be just a government protection mechanism at this point, because it really has no economic benefit to the banks to spend money on a system that they're spending money on. They have to spend money on cybersecurity. They have to spend money on the expertise. They have to spend money on a broad range of things to keep these systems not only compliant, because they must comply with central bank regulations, but also the electricity to run these systems, train people. There's an immense amount of cost that goes into it. In fact, I would argue that the administrative fees that they put into loans, although part of it comes down to the people personally having to go into the registry and make sure that all the ducks are in a row, all the legal ducks are in a row, all the, that the properties are not in significant arrears, land tax. Like, there's a lot of physical work to be done by those bankers to do it, since the government themselves don't, with all this technology that we are promoting as a government and a country, don't have a real way for these people to interface without talking to somebody. And sometimes the government person's not there, or they have significant backups like what's happening at corporate affairs. And sometimes BRA has the issues. If a lot of this stuff was computerized, then, or real time in nature, then I would say, well, the bank should charge a lower fee, since it's easier for them to conduct business on the loan at low end in terms of administrative fees. But as it stands right now, it's cheaper for the banks, in theory, to engage in these things from a time perspective. Yeah, from a time perspective, it takes a lot more time to deal with a loan than to send the transaction, but to upkeep that system, the ACHs and whatnot, is a lot more expensive, in my view, to the bank. So I understand from that costing perspective why it's expensive, or why they would want to charge a fee outside of what I explained to you earlier in terms of the economic pressures on them. But if the government really wanted to sustain this take that the banks won't want to make fee-based income on transactions going forward, or say charge very random fees, the government on its end, to me, it would be more efficient that they try to make it easier on the loan generation side for the banks to make money there. In other words, to reduce, not make money, but to save time and money there, and pass that on to people on the loan generation side as well, by improving the way that banks can actually communicate with corporate affairs, with land registry, with all of them, with the courts. There's no reason that you should have to walk in and physically do most of this stuff that takes time and money, and you got to pay gas and all of that. So that's why you need to pay admin fees in the banks for loans and many things. So suffice to say, my take is that long term, should government not improve the infrastructure that allows the banks to perform their fiduciary duties, especially in loan generation, and the economy remains soft, and Bajans continue to deposit aggressively, and it could be the Bajans with the cash, I should say, deposit aggressively as opposed to investing their own money. If that behavior ensues, the banks will find it hard to lend consistently over time, and there will be pressure for them to continue finding ways to generate fee-based income to supplement the falling amount of profitability from the loan generation activity on their portfolios. So suffice to say, as business persons, there are accounts at the banks that are not interest bearing and they don't attract fees and whatnot. You could try to engage in those if you want a source of funds that you wouldn't have to pay administrative fees on. And you're supposed to go into your bank and ask for those types of accounts. They are available, have been for over a year or so now. Other than that, you just have to anticipate that there will be in the future more attempts to either engage in fee-based income. There may be attempts to challenge the central bank down the line. So far, it hasn't been the case. And, there may be campaigns to find other ways to do it. They may raise interest rates on loans even further, which would even necessitate in the near future, even a greater call for fee-based income, as I told you, So, and it would be less of an incentive for you guys to save. And this, in the end, to close, would end up affecting credit unions. Credit unions can't take deposits. That's a whole legal issue, right? If there was a credit union bank, then every credit union would be able to bank your money and deposits will be pooled there, which presents its own financial risk, having all those pools in one place, right? But essentially, what ensues right now is that they said the credit unions have to deposit your money and find deposit insurance in other ways. You know, it's not enough to the $25,000 limit I told you guys about earlier, enough for any credit union who's depositing their members and shareholders' funds. So that's why a lot of them engage with private insurance. And private insurance has its benefits, but it's also costly to members. So, you know, the credit unions could actually reduce significantly the costs, their own operating costs in terms of protecting members' funds if it were that the credit union bank was around, while on the other end, it presents a greater risk for credit union funds. So because it is inextricably linked to the banking system, it's not a part, it is a part of the banking system. All of these measures I'm talking about affect them, right? Credit union will attract fewer and fewer dollars in its deposits. It may try to hold more long-term deposits for the larger interest rate so that it can help finance the even larger interest rates that they give you guys. But to me, really and truly, is almost a fool's game unless they have their own bank. It is. There will come a point where those long-term, and this is why the social media commentator guy told you about could create such fear. I mean, management aside, the criticism of management aside, he could create the fear because it's very difficult to sustain these high interest rates on these long-term loans in an environment where deposits are low, in an environment where dividends from stocks on the public exchange, on the Barbados Stock Exchange, are dwindling. You know, you have fewer options to invest. And the credit unions are highly limited as well, unfairly in my view, in terms of how much they can invest in alternative assets like their own real estate and their own, let's say, retail ventures. They could invest almost like Islamic banking in different ventures as well. That is limited to 10% of their overall portfolio. The banks don't have those limits. So it's a little unfair where it's at, but it's meant to protect the wider society, but it limits credit unions in a way that almost says to me that should the economy not open back up in a respectable time, that you would expect that the credit unions can't provide as much interest rate on their fixed deposits, long-term deposits to their members and shareholders. So I end on that point to say that just expect that should the government, again, not look at increasing the efficiency that allows banks to and credit unions to justifiably pass on the savings of time through saving money to their people, through not having to go down by land registry, not having to call, not having to waste time, money, gas, pass that on, as well as probably helping to sustain as long as possible the lack of fee-based income for transactions out between banks, especially since that affects the poor man way more than the rich man. The longer that sustains, or the government avoids doing that, I should say, and the softer the economy remains, in other words, the government not having the ways and means to drive economic growth or get investors to come in and promote economic growth, give that big boost, that big long-term kick. The longer that stays, more likely we will be paying fee-based income and higher interest rates going into the future, which might very well drive, in the end, more of a cash-based economy, which has its own costs. Cost the government's tax revenue, and that's another discussion altogether. From the time you start to drive no cash-based transactions again. End there, and to answer quickly the question sent by the member, trying to figure out are short-term loans better for us? Only good if you can manage your cash. Only good if you manage your cash into high producing assets. You know, to borrow from a credit card to pay your gas, to drop school your children, and the business isn't making money isn't the best thing. But I mean, Americans do this all the time. To borrow, to buy assets, or to get the assets and tools you need to enter into a contract that will pay you in a timely manner. Yeah, we promote that all the time. Just don't go over your limit. The long-term loans allow you better to manage your cash, right? And thankfully, short-term loans are not as large as long-term loans. You can go for hundreds of thousands of dollars versus, you're limited in the low thousands in most cases with credit cards and unsecured loans. But the main thing is, the principle is, if you can get your money back quickly, then short-term. If you're going to take a long time to get that contract, better to have a long-term loan, especially if you have security. I end there. Thank you for your time, and I guess we have time for questions.
Thank you to Jeremy for rather comprehensive presentation, rather detailed, might I add, on this issue of the business of banking. I have lots of takeaways, I must admit, and some follow-up that I will wish to engage you on for a few minutes. Colleagues, we've exceeded our time. As you know, our webinars are usually 11 to 12, but we are now at
Sorry.
12:30. At 12:30. So I'm gonna ask if colleagues, if you wouldn't mind giving us another 5 minutes for discussion. Kindly proceed to put any questions, comments in the chat. Jeremy will see and respond. But Jeremy, give me some takeaways though. I'm hearing that Islamic banking is clearly a better model for especially for small business persons who, because they know interest rate being charged, incurred, it allows the small business to be able to access the resources without having to worry about high interest rates and so on, and be able to pool resources in the interest of, whatever that long-term developmental goal is. So that this Islamic banking model, we know exists right now in another section of the Barbadian community.
Yeah.
But I think to some extent the credit union model, to some extent was, mimics that. But clearly the Islamic banking model is maybe one that, we need to consider. So that's a takeaway for me, at least. A couple of others, and then I have a couple of questions here for you. You're saying that the banks don't drive growth. They sustain growth, but they don't drive growth.
No.
That tells me something then about the cannabis industry. So I want to weigh in on that. Is that why our commercial banks have literally,
Yeah.
as the pilot, washed their hands off of the cannabis industry? Because that's a new industry here in Barbados.
If I can answer that before you move on to the next one really quickly. It's a very simple fix. I'll declare my hand, because some of you might be cussing me. The fees that you guys see, I was the person that came up with them, right? I was engaged to examine those fees. So I have a very intricate knowledge. I also knew very early on that the banks wouldn't touch it. And it's for a very simple reason. It all has to do with de-risking. So in the United States of America, at the state level, you can have, depending on the state, cannabis licenses, and you can bank at state banks. State banks have that charter. The problem is that most of the banks that we use as corresponding banks tend to have what you call federal charters. In other words, they can operate across all 52 states or 48 states, whatever they are. Now, 50 is 50, right? I can never remember in American, but yeah. So they can operate across those. The problem is that the federal government pretty much is the regulator at that level, and the federal government has never legalized nor decriminalized cannabis. So as a result, any banks that receive proceeds, even as what you would call corresponding banks, those are the ones that keep the bank accounts of our local banks over there. So when you wire money, it's basically an instruction coming from CIBC over here to Bank of America saying, well, hey, send this money on to X and Y. The problem is you can establish a link between that instruction down in Barbados, say cannabis money coming in, and money being released from the bank account in the US to go elsewhere. So here lies the issue. That bank has basically transacted illegal gains according to federal law in the US. So that's why none of the banks in the Barbados would ever touch it. So the only way you can get away from that is if the federal government in the US legalizes or decriminalizes marijuana firstly. From the day that happens, the business thrives in Barbados. If we do not, here's the catch: find other sources of corresponding banks. The Canada pretty much decriminalized it, but Canada doesn't keep a large store of US dollars. So as a result, most of our banks wouldn't use them as corresponding banks, principally for US dollars and Canadian dollars. So there lies the another challenge: who to find US funds in the interim until they do whatever. So like it's difficult. It's very difficult. I mean, there's a way and means to get around it. I'm not going to advise through this forum, but it does involve actually having, let's say, a presence or partnerships in local states, like Colorado, having a partner in Colorado that could be a financing partner. You run your accounts through there. Once it doesn't touch the Barbados banking sector, it would mean, for instance, it's very difficult. You need to use a card, and even then, that's challenging. Use a card linked to overseas account, all kind of nonsense. So for the long run, until the federal charter comes through, we're pretty much hamstrung. With respect to the Islamic banking, I believe in that. I first came across it when I did my master's in England. It made sense. It made sense at a very large level. I don't want to say it is better. It is only better if you have the right management sources in play. Governance is important. You must have a better governance model than what is presently available in Barbados at the credit union level and the commercial banking level in order for it to work, because you have fewer controls. You don't have a legal document that says I can seize this person's home if they don't pay, right? You're an investor in the home. You would have to be bought out. You have to go to court to be fought to be bought out as an investor in the home. There's some equity that remains in the hands of the borrower, in quotation marks. So if you don't have a strong governance model that helps you to monitor and choose the right people to lend to, or if generally there's a lack of trust in society, Islamic banking cannot work. So that's a principal thing that has to happen.
Right. So there must be that regulatory regime to support it.
Oh yeah, you gotta be strong. You can't be friends and just so. You gotta be really strong on it.
There are two key questions here, but I mean the $25,000 deposit. You made a point there. Just want clarification if I heard it right. That $25,000 dollar deposit insurance that's provided in that regime, that is per bank, you said, and not per account. Nope. So if I have 2 or 3 accounts in a bank,
don't matter.
that the maximum that I will be insured for is that $25,000.
Yep, that's so the only thing you get to know.
It's really in my interest not to have so much money then in the bank, in any one bank, in any one bank for that matter.
Well, you see, somebody's even saying different, that they thought that was per account type, but now, as far as I have always known, it's always been per bank.
Yeah, I thought it was per account as well.
I could, if I'm wrong, I'm willing to be corrected. But as far as I've always known, it's been always per account. Because when I was much younger, not per account, per bank. And so somebody could correct me if I was wrong.
Yeah, but no, that is definitely worth some research, huh? Because then that really don't provide the kind of protection that I think the average depositor in this country may thought that he or she had. But
I mean, if there's any media here, don't quote that part. It just so, I mean, I'm fairly certain, but again, I am willing to be wrong. So somebody said she researched it last year. Let's go with that as per account type then. Let's leave that there for now. Somebody said they researched it last year. What I knew up to when I was teaching 2020 was that it was per bank and not necessarily per account type. That's what I knew about.
But you taught this stuff at UE, so hey.
But hold on, I could be wrong. I am willing to somebody to say that I ran wrong with wrong information. I am not ashamed. I can share somebody tell me I'm wrong. But I am reasonably confident in the other things that you said. But if somebody says that it's not so, then so be it.
All right, I want to get your take on Zaria's question as well as Roger Barrow. The two good questions here. Zaria Griffith and Roger.
All right,
Right.
so Zaria is asking, what would I advise an individual going forward in regards to the best way to go about banking? Um, don't use the bank to make money. Well, yes, use the bank to make money without making money from the bank. So, as I said, I prefer at least until certain things pertain. Number one, I mean, you don't have to go as deep and look at the gap between liabilities and assets as I showed you. But until the economy gets better, the bank is probably better as a store for transactional purposes. And it's probably better for you to make your money through what your business. And I mean, it might help the business know, right? I'm not saying that you have to use people like me, but the importance of going out into the region has never been more profound. And the importance of having a regional outlook along with your local outlook has never been more profound. I can almost guarantee you, I know weekly, multiple times per week, there are people that business persons in this country, some that are within this very chat, that leave Barbados to head out for contracts and whatnot weekly. That's happening more and more. I've seen the increase of it. That's the reason why me and my business partner started this business, right? To help to promote that. So the main thing is this, that, you know, use the banks for transactional purposes, build a store, keep your accounts in order. Once they see funds coming in and they get an idea as to how you manage the funds, you could always extract a loan, especially if you have a business account or on the personal end. Take time to extract that opportunity, 3 to 5 years, and so be it. That's the only thing in terms of banking. There's several other products that may appeal to you depending on your stage of business and life as well, and that may be good. Mutual funds through the banking system, all of that. But starting out is really a store of value. Don't really think about saving, think about using your cash wisely. Put it into productive assets. Think more of productive assets and think of the bank as one of those assets. And if the yield from that isn't as high as the others, fine. But if you need money to have aside to pay salaries just for that level of certainty, so be it. But putting all your money into the bank, all your salary into the bank, isn't useful in an economy like Barbados, especially one that is 80% driven by consumer spending. You literally need to produce in order for your money to grow in Barbados. That's the truth. The bank isn't going to make you rich. And
Right.
Roger had that question.
How about ZP?
ZP. Uh,
A money transfer business like ZP, which
yeah,
regulatory institution or agency do they need to consult?
the FTC. The FTC, they wouldn't fall under the central bank. They're not a bank. The central bank regulates banks. Financial institutions are under the remit of the not the Fair Trading Commission. Oh my God, FSC, the Financial Services Commission. So that's who you would need to consult if you're speaking about validity of business, track record, all of that, requesting information on not shareholders, but definitely executives and whatnot. Business plan, I think, as well, is something that has to be submitted to the regulators. I'm not sure if that's available for public consumption, though. But those, you should consult with the FSC for sure.
Yeah. But what I'm hearing is you use the banks primarily for transaction purposes. Don't have any significant savings. I mean, this presentation, if nothing else, really showed me that there's no significant benefit to having a lot of savings in the banking sector.
But financial
Um,
benefit,
you know,
if you're looking at return on investment, but some people want a nest egg. I mean, if you're not a
mhm,
risk-taking economy, then shoot, leave your money there and make nothing from it and let inflation eat it away before it is eaten away from the time you take it out. You know,
mhm.
a dollar invested today in Barbados sure as hell be worth really and truly 75, no, 80 cents in about 2 years at this rate.
There you go.
So,
So it's better
yeah,
to invest it into mutual funds and any other
yeah,
investment instruments that you can
yeah,
consider than just
exactly.
leaving it there. That's the point. And just leaving it there sitting in a savings account, and for small businesses, and that graph you showed earlier that didn't reflect at all sole proprietors and business people in that pie chart,
Mm-hmm.
confirms already that there's not a lot of activity for our sector. Not a lot of lending, except it is maybe to get a car. And my former chairman Charles, I see him on the call, has made that point repeatedly. You can get money easily to buy a car, but not maybe to buy equipment for your business
Nope.
to scale up, to help finance operations, etc. in the business. So you use the banks really for transactional purposes. That's a takeaway for me for sure.
Well, I'm glad you had a good takeaway.
Yeah, I had
Forget-
several. I had several, don't worry, several. But we're gonna wrap up now. We've gone past the time, but it was very, very, very informative. Jeremy, I thought, and the comments from our audience bear this out as well. Here's a final one from Michelle before I close out. If you want to take a stab at that.
Say again?
There's a final comment here from Michelle.
Okay. Let me
Um,
see.
that is where a lot of us go wrong. We think putting
Oh,
money to sit in the bank is saving it. So does Barbados have interest-free savings
yeah.
account programs like
Yeah.
Canada?
Yes, it does. The checking accounts. Again, there are, and I thought I mentioned this, but maybe I rambled. Every
Mm.
bank since last year apparently has a bank account that you have to ask for it. However, I don't think they're being advertised. It's not in the bank's interest really, but to advertise them truthfully. But every bank is supposed to have an account that does not attract, and it doesn't pay any interest, but it also doesn't attract any fees as a result. So I mean, they're there. You just need to ask. That's the truth.
Mm, mm, mm. Right. Okay. All right. Thanks very much, Jeremy, and thanks, colleagues, for participating in this our first information session for 20. Rest assured that we have some interesting, very attractive topics in store for you for the rest of this year. So look out for February session and each month thereafter, God willing. We are going to address those topics that you've shared with us that are important to you. So again, we will share the information via our usual platforms, our email blasts, social media platforms, and so on, and we invite you to participate. So let us pause and thank Jeremy. Jeremy, very, very, very well done. Lots of information shared. I'm sure that person's had, just like me, a lot of takeaways from the session today. We are again indebted to you, Jeremy. We thank you for coming on and sharing your wealth of knowledge with the association and our stakeholders. So, colleagues, please, if you have a few moments, you don't have to rush off. I know some members sent me personal notes that they had to go. We thank them. But please go to the chat now and you'll see a link there. It says feedback form. Please click on the link and share your thoughts on the session. If you have an interest in additional topics for the future, let us know. I already see that someone is asking for us to look at personal investing and so on. So we give that some thought as we go forward and planning our sessions each month. So please take a few moments, complete the survey form for us, give us your feedback so that, as I said, we can plan as we go forward. So once again, thank you. Thank you for the extended time as well, because we've gone past our usual time, but justifiably so. It was very, very informative. We want to hear from you as we go forward in this year. We're going to be conducting several of our quarterly surveys, and we expect, I hope that you would participate, because the feedback is important in our planning, in our lobbying, in our programming. So please participate in these activities as our team reaches out to you. So that's it from us here at the Secretariat. Thanks again for participating in this month's session. And we look forward to seeing you on another call at another time. God bless you all. Do have a good day. And bye-bye for now.